The scanner hands you a setup. The backtester is where you decide whether to trust the setup and, more importantly, where on that setup you want to participate. This is the most powerful research tool in the platform because it doesn't just tell you if a name works. By running it a few different ways and comparing the results, it gives you clues where the edge actually lives on a stock, which model you want to lean on, and when a trade is quietly telling you to get out. Now let me show you the backtester page first, how to use it, and then I'll show you how to read the results. Everything starts on the left-hand side in the backtester. I call this the control panel, and here's where you can input the symbol. You can put any one of the stocks or ETFs that we support, and then you can start to pick and choose your different filters. If you want to look at all models first, select all, but eventually you'll want to choose each one of these toggles to get into a little bit more granularity to determine clues. So you can choose between the daily models only or the hourly models only, the aggressive ones only or the conservative or both, and then same thing with the direction, long, short, or both. Now finally, you'll notice there's a date range column. And this is really useful if you would like to test how the models perform during different market regimes. So that's how to use the dates, otherwise just leave it as the default. And that's your backtest. You're asking one very specific question, which is how effective were the models, which models to be using, and running this backtest. Now when it runs, you'll find that there's three different things that fill up on this right-hand side. At the top, you have the headline numbers. And the two that I'm paying most attention to are the expectancy and the profit factor. A positive expectancy means that this setup on this model makes money per trade on average, and that's a good sign. Combine that with the positive profit factor, which means it's greater than 1. That means that there's more dollars won than lost. Both good signs, both things we want to see, and you'll also be able to use just the green color for a very quick visual cue of this. Now in the middle, you'll find the cumulative P&L curve, and I like to see a steady climb up to the right side. Below this P&L curve, you'll find the trade log, and this gives you an idea of every single time the setup fired. And that's really the entire backtest page. Now here's where you can start to use the backtester page to get clues, especially when a setup is triggering real time. On its own, you can get some quick decisions around how effective the models are, but if you just have a few clicks here, you'll see that the information becomes substantially more useful. So let's go through some examples here. I'll show you three different clues that I like to test for. Clue number 1, which is going to show you when you want to be a little bit more conservative by default and use the aggressive models more like an alert. Now, if I pull up Coinbase, and let's test Coinbase on the daily models with the aggressive sensitivity loaded on. And if you take a look at the results, it should be fairly obvious that the results are ugly here. It has a 41.9% win rate, so less than a coin flip, a negative trade expectancy of 0.68, and a profit factor of just 0.67. The equity curve just bleeds lower and lower. Now, a lot of people would see this and just throw Coinbase out altogether as a setup. Don't. Let's now change one thing. Switch this from the aggressive models to the conservative models, and let's rerun the backtest. So everything else stays the same. We're still looking at Coinbase, we're still looking at the daily models, but we've just changed our sensitivity from aggressive to conservative. Now all of a sudden you see that our win rate is above a coin flip, 59.8%, almost 60%. Our trade expectancy is a positive 0.63 and our profit factor jumped from 0.67 up to 1.54. And you'll see this very clearly in that P&L curve, which is climbing. Now this isn't a fluke. If you run United Healthcare the same way, you'll see that it's even sharper. The daily aggressive models have a profit factor of 0.66. The conservative flips that up to 2.56. So what is that telling you? What is this clue that you should be getting? Well, A, when price first tags the aggressive volatility box models, that's not your entry. When you see that on the live scanner, that's really your first alert, if you will. The edge isn't right at the aggressive line. It's somewhere between the aggressive and the conservative. So when price does hit the aggressive, you start paying attention, you hunt your entry with the edge signal in the zone, but you're waiting for that entry to be much closer to the conservative volatility box models, if not inside of the clouds. The backtest just told you where to wait, and you were able to know that, hey, I should be paying attention starting the aggressive volatility box breach. So that's clue number one, testing the aggressive models versus the conservative and determining some clues. Clue number two is the trade telling you to get out, an early clue that, hey, maybe this trade isn't going to work. Let me show you how you can infer that. Now, let's come in and let's run the hourly volatility box models, and this time we'll run it on Apple. Let's hit run backtest, and once we run, you'll see that 55.1% win rate, a profit factor of 1.30. Now, if you run the same backtest, but this time we flip it just like we did before, but this time you go hourly conservative, you'll see that this backtest falls apart. All of a sudden, that win rate dropped from 55.1% on the aggressive models down to 49.5% on the conservative models. The profit factor dropped from 1.3 down to 0.97, so that's now below 1. This combination is a different kind of clue, and it's about risk. What it's telling you is that as long as price is holding our aggressive volatility box models, you're fine. The edge is still there, and it's a good time to stay in the trade because we're very much likely to see this nice reversal. But the moment that price breaks the aggressive volatility box models, rather if it does, and say it starts to push towards the conservative, history tells us that this move now historically does not pay. The break in volatility is expanding, and really any kind of rallies, if you were say long, you want to use that to exit out your position gracefully, given that this move is now breaking outside of our traditional backtest. So the backtest didn't just find your entry, it also gave you this rule, this clue around when you might want to leave based off of when the aggressive versus the conservative models are performing better. In the first clue, we looked at where the conservative was better than the aggressive. In the second clue, we understood what it means when the aggressive performs better than the conservative. Let's now move on to the third example of a clue that you can infer. If you run a name on the daily and you run it on the hourly and then you compare, and I'll use Disney as an example here. So on the daily aggressive, it's excellent, 60.9% win rate and a profit factor above 1 at 1.61. Now I'm going to run that same exact name, so Disney again, but this time I'm going to run it on the hourly models. And notice how the backtest goes a little bit more closer to that middle mediocre line. 52.1% win rate, and again the profit factor barely over 1. That tells you that Disney is essentially a daily name if you can get the daily edge. Its edge is the slow multi-day move, not really that fast intraday chop that you would get with the hourly models. You want to wait for that one day that the daily models do get breached because that move tends to pay much better than even a lot of these smaller trades in between. Now, other names are going to be the opposite of this. They'll be dead or much poor performing on the daily models, but very much alive and thriving whenever volatility is kicking on the hourly models. So you want to use these clues to try and figure out which models you want to pay attention to, especially for your favorite names. So hopefully through this video, you understood that the backtester isn't at its bare bones just a scoreboard. More so, I think it's your labs. It's a way that you can run a set of experiments on your favorite stocks. You can test the aggressive versus the conservative. You can test the daily versus the hourly. You can test different combinations of these time frames. All of these give you clues around what volatility is doing, how volatility is performing, and how volatility has performed historically. If you start with these tests, you run them every single week on your favorite symbols, you'll also be able to very clearly observe and notice how volatility is shifting over time. Now in the next video, I'm going to help you set up your own watch list and alerts, so once you've found the names worth trading, the platform now watches them for you. Say you find that you want to be alerted whenever X, Y, and Z breaches. In this case, we looked at United Healthcare, the aggressive models. You want to be alerted? I'll show you how to set up those alerts on the next video. So once you do all of this research one time, you can actually make use of it and profit every single time that X, Y, and Z condition triggers. See you in the next video.